dividend ETFs can offer consistent income, solid diversification, and great long-term returns, but with hundreds of different dividend ETFs on the market, it can make it difficult to decide which ones might be worth investing in. And in this video, I filtered the list down to just 4 ETFs that work a bit differently from each other, but we'll be ranking them across a few different categories to see which one stands out as the best dividend ETF to invest in. To start it off, let's talk about what makes these 4 ETFs different. The first ETF that I want to talk about is cgdv, the Capital Group Dividend Value ETF. This actively managed fund aims to generate consistent income that's higher than the average yield of the S&P 500 by focusing on companies that pay dividends or have the potential to pay dividends, as well as that invest in companies that have the potential for capital appreciation. Now let's get into a quick breakdown of this fund and its strategy. First is that cgdv invests at least 80% of its assets in dividend-paying stocks. It focuses on larger and more established companies that have market caps of over $4 billion. It also may invest up to 10% of its assets in stocks of larger companies that are outside of the US, and this added diversification is a nice plus. Next up is dgro, the iShares Core Dividend Growth ETF. This fund seeks to track the Morningstar US Dividend Growth Index, which is made up of stocks that have a history of consistently growing their dividends. And there's a few criteria that this fund screens for. First is that companies must have a minimum of 5 years of consecutive dividend growth. Also, the dividend payout ratio must be less than 75%, and the payout ratio is the percentage of a company's earnings that are paid out to shareholders. REITs or real estate investment trusts are excluded, and it also excludes the top 10% of the highest dividend yielding stocks, as well as companies are also weighted in their proportion to the value of their dividend payments. The index has a 3% stock cap, and it's rebalanced quarterly and reconstituted annually in December. The third fund is dgrw, the Wisdom Tree U.S. Quality Dividend Growth Fund. This fund seeks to track the performance of dividend-paying large-cap companies with growth characteristics, and dgrw has a pretty unique process for its selection criteria. First, it starts with dividend-paying stocks from the Wisdom Tree U.S. Dividend Index with market caps greater than $2 billion. It excludes companies with dividend coverage ratios lower than 1, and this ratio shows how many times a company could cover its dividend payouts with its earnings or net income. Then it does a composite risk screen to exclude potential value traps. Next, it ranks stocks using a weighted combination of 3 factors: 50% weight on medium-term estimated earnings growth, 25% weight on 3-year average return on equity, and 25% on 3-year average return on assets. And last, it selects the top 300 stocks with the best combined ranking, and then it has a stock cap of 8%, and then sector caps of 30% for technology, and then 10% for real estate. This next fund is fdvv, the Fidelity High Dividend ETF. fdvv seeks to track the performance of the Fidelity High Dividend Index, which invests in large and mid-cap dividend-paying companies that are expected to continue to pay and grow their dividends. This index has a few parts to its selection criteria. It allocates at least 90% of its holdings to the largest 1,000 U.S. stocks based on market cap and up to 10% of the largest 1,000 developed international stocks. For sector weights, sectors with higher dividend yields are overweighted, so up to 40% of the weight is reallocated to the highest yielding sectors. Stocks without a current or indicated dividend yield are excluded, along with stocks with the 5% highest payout ratios. Next, a composite score is calculated by selecting top stocks in each sector based on dividend yield making up 70% weight, payout ratio at 15%, and dividend growth at 15%. There's a modified cap scoring approach next, and then the highest ranked stocks are selected within each sector and country by score. And the fund is rebalanced and reconstituted every single year with quarterly reviews for stocks that have stopped paying dividends. Now that you have a much better understanding of how these ETFs work, I'll be ranking these ETFs on a scale of 1 to 4 for each category, with 1 point for last place, 2 points for third, 3 points for second, and then 4 points for first place. Alright, so let's go over the portfolio of these ETFs to see how they differ and rank them on their level of diversification. Kicking it off with cgdv, this fund currently holds 52 stocks in total, and its top holdings are in Eli Lilly, Microsoft, Broadcom, Nvidia, GE, Starbucks, and more, which make up a little over 40% of the total portfolio. As for the sectors this fund is exposed to, it includes technology, industrials, healthcare, consumer discretionary, and a few others. It leans a bit more into tech, but it's not overly exposed, as there's some spread in those other sectors. Next, for dgro, this fund currently contains 397 holdings, with top holdings in companies like Johnson & Johnson, Apple, JP Morgan, Exxon, AbbVie, and others that make up about a quarter of the portfolio. For the sectors, dgro is mostly exposed to financials, technology, and healthcare, and you can see it's pretty diverse in its exposure to holdings. For dgrw, this ETF contains 200 stocks in total, and its top holdings include Microsoft, Nvidia, Google, Exxon, Home Depot, and more, and they make up a little under 40% of the weight of the portfolio. For the sector exposure, you'll find technology at the top, then healthcare, financials, and communication. And the fourth ETF, fdvv, this fund currently holds 120 stocks, and its top 10 holdings are in familiar names like Nvidia, Microsoft, Broadcom, Visa, Citigroup, and others, which make up around a third of the total portfolio. And the sectors it's primarily exposed to are technology and financials, which together make up almost half, along with consumer defensive, real estate, and a handful of other sectors. So I'll be ranking these ETFs based on how diversified their portfolios are. And for last place, I'm going to have to give it to cgdv. The reason is it's the least diversified fund because it only has 52 stocks, so it has the least amount of holdings in the group, and these top holdings make up a little over 40% of the fund. And third is going to be fdvv. While it's slightly more exposed in the top two sectors compared to cgdv, fdvv has 120 stocks in its portfolio. And second, we have dgrw, and in first place, it'll be dgro. dgro has the most amount of holdings, and its top holdings don't make up as large of a chunk as the other funds. All four of these funds have a nice spread of exposure to a variety of sectors, and they're pretty similarly balanced in that exposure. So the total amount of holdings and the weight of the top holdings were the biggest determining factor here. Next is going to be all about the dividends, so the dividend yields, growth rates, and consistency. cgdv is first with a dividend yield of 1.28%, which is paid out quarterly. Now normally I'd compare the 5-year annual dividend growth rate, but cgdv was created in 2022. And since it was created, it's had an annual dividend growth rate of 45.5% and 2 consecutive years of dividend growth. So keep in mind it's fairly new, and that value looks so high since that first year increase was so large, and there's been only 2 years of growth to measure. Next is dgro with a dividend yield of 1.97%, which is going to be paid quarterly. And dgro has a 5-year annual dividend growth rate of 6.8% and 10 years of consecutive dividend growth, which means its dividends have been growing every single year since it was created in 2014. Now, for dgrw, it currently has a dividend yield of 1.3%, and unlike the others, it pays dividends every single month. It also has a 5-year annual dividend growth rate of just under 5%. And when it comes to its consistency, it's only had 1 year of consecutive dividend growth, which you can see over time its dividends have increased, but some years it was slightly lower. Last up is fdvv with a solid dividend yield of 3%, and that's paid out quarterly. fdvv has a 5-year annual dividend growth rate in the double digits of nearly 10.5%, which is really great. But currently, it doesn't have any years of consecutive dividend growth. It has fluctuated a bit over time, and the most recent year, the dividend was a bit lower. Getting to the ranking for the dividends, cgdv is going to come in last place again with the lowest yield of 1.2%, which its strategy aims to slightly beat the S&P 500. Also, while cgdv does have some promising dividend growth, it's still pretty new, so it'll be interesting to see if it can maintain consistent growth as it gets older. dgrw is a close third, and the only reason it didn't come in last is just because cgdv doesn't have enough dividend history to make a fair comparison, since the yields are very close. dgrw can provide some dividend growth over the long term, it's just likely that it won't be consistent. And second place is going to go to dgro, which leaves first for fdvv. dgro and fdvv both provide some very solid dividend growth and dividend yields. While dgro has proven to have the most consistent dividend growth by far, fdvv can still offer some nice growth and do so with a higher yield, but you could make the case for dgro here. Now let's compare the fees between these 4 ETFs. With cgdv first, this ETF comes in with an expense ratio of 0.33%, costing you $33 per year for every $10,000 invested. A bit high, but remember, it's an actively managed fund. Next is dgro with an expense ratio of 0.08%, costing $8 per $10,000 invested. Then dgrw with an expense ratio of 0.28%, and fdvv with an expense ratio of 0.15%. Now this ranking is pretty straightforward. cgdv being the most expensive is last, then dgrw in third, fdvv in second, and then dgro comes out on top with an expense ratio of just 0.08%. All these fees are still relatively low, but it's still important to check the fees when looking at ETFs. Also, keep in mind that these fees are baked into the total returns, which we'll be jumping into next. When comparing ETFs, performance is oftentimes the biggest factor for investors to consider, so which ETF has the best returns? Starting with cgdv, since it's a fairly new fund, its history is short, but it's had annual returns of just under 24% in the last 3 years. And in 2025 alone, so just shy of a year, it's had returns of about 24.5%. Some really amazing returns, which have actually outperformed the S&P 500. For dgro, this fund has had 5-year annual returns of 12.4% and annual returns of about 13% over the past 10 years. Next up, dgrw has had 5-year annual returns of 13.4% and annual returns of about 13.5% in the last 10 years, which is great to see. And last, we have fdvv, which has had 5-year annual returns of nearly 17% and annual returns of just over 13% in about the last 9 years when it was created in 2016. Now let's take a look at a chart with all 4 ETFs to see how the performance varied. If we look at the total returns since cgdv was created in February 2022, almost 4 years ago, right away you can see how much cgdv outperformed the other funds over the last few years, with almost no competition there. With fdvv the runner-up next at around 65% returns, and the others not too far behind that. This brings me to the ranking, which for 4th place, we're going to have to give it to dgro. Now while it's a fund that gives you a mix of exposure to both value and growth stocks, its performance just slightly fell short of the competition. dgrw is in third here, as its strategy of choosing quality stocks gives it exposure to a mix of some growth and defensive names, making it a relatively resilient fund. Because of that, it's going to fall a bit short in the performance compared to the top 2 picks. Which in second, we have fdvv, and while this also is a blended fund, it leans into those big tech names, which has helped a lot in growth in more recent years. And this leaves the number 1 pick, cgdv, which has had some incredible returns compared to the overall market. That's due to its active management, allowing the portfolios to choose what they consider as strong companies that pay dividends, and they can make adjustments to the portfolio based on market conditions. This strategy has provided cgdv with a solid mix of growth and value companies with growing dividends and performance that aims to beat the market. So what final score does that leave us with? In the end, it looks like we have 2 funds that are tied, and believe me, I didn't do this on purpose. While the gap in the scores might seem large, that doesn't make these funds that much better than the other. Each of these funds have strengths depending on the category, and that's important because depending on your portfolio and your goals, that's going to determine which ETF is the best. I think for an overall well-balanced fund that offers diversification while still providing growth potential, dgro takes the win over fdvv and its more concentrated portfolio. But if you want something with high growth potential and don't care much for the yield, in that case, cgdv without a doubt takes the cake. Each one of these funds have a benefit over the others, and that's up to you to decide the one that suits you best. Now, if you want some more options, I talk about the 6 best ETFs to live off of dividends in this video here, or if you want to see which ETF gets you rich faster between dividend ETFs and growth ETFs, then check out this video here. If you made it to the end, thank you for watching, and don't forget to tap that like button and subscribe, and I'll be seeing you later.